Hello everyone. In this chapter, we're going to discuss another very important topic for our business, which is critical for them to decide whether they want to start a new project or not. Do they want to continue with an existing project? Do we want to introduce new products? How are we managing the cost? Are we progressing? Are we able to reduce our cost? Are the costs increasing? So a lot of that we've discussed so far in the cost chapter, that leads to a certain topic that we're going to discuss today. And that topic is called break-even analysis. I'm sure you would have heard this term many places, break-even, getting even, things like that. So that's what we're going to focus on. Why would a business want to just be even? And the root of that topic takes place in the most basic formula that we've seen, and we kept on using this throughout our course, the profit formula, which is profit equals revenue minus cost. That's where our conversation is going to begin. Now, we have so far established that there are two types of costs: fixed cost, variable cost, and a collection of those two, when you combine them together, forms total cost for the business. And let's say, for simplicity's sake, we're going to assume that a company is only making one product right now, one unit, and that's it. And the cost of making that unit turned out to be, let's say, $400. Now, my question to you here is that if something that costs you to make $400, how much would you be willing to sell it for? Now, remember, and I'll just highlight it here again, that revenue is calculated by using the formula price times quantity. And we just assume that quantity is going to remain 1, right? So the question really becomes, what price would you want to sell it to make sure that you're at least breaking even? Making a profit will obviously come later. If I told you that you could sell it for 300, would you accept it? Surely the answer is no, because that means that if I take 300, for example, with a cost of 400, I'm making a loss of 100, not a profit. So that's not a good scenario for me, right? What if I offered you 350? Would you take it? I'm sure your answer is again no, because that means we have a loss of 50. However, I think you will consider selling it at 400. Because if I sell it at 400, it costs me to make 400 as well. That way, I've got no profit, not a loss either. So I'm breaking even at this point. So break even, the concept that we're looking at today, has a couple of conditions. And those conditions must be met and must be explained together for anyone to fully understand what break-even stands for. And the first of those conditions is that break-even is that point at which you're neither making a profit nor making a loss. As we clearly saw here, it cost us 400 to make. 400 we sold it for, yielded us 0. No profit, no loss. It's all right. I mean, you worked hard, yes, but you were also able to cover all your expenses and move on to the next day or making the next product. So things are broken even there. Now, in order to explain break-even, you must include a second point with it. And that says that this will occur at the point where your total revenue is equal to your total cost. Once again, these 2 points must be explained together. One leads to the other, right? We get to the point where where revenue equals cost, and that's where you're neither making a profit nor making a loss. Together, this is known as the break-even point. Okay? Now, there's a couple of ways to use the break-even concept for a business. One of them is through a graphical method. The other one is through a mathematical calculation method. And we're going to look at both, starting with the graphical method first. So we're going to start off with the graphical method first, and we're going to make use of all the little concepts that we've come across this chapter: fixed cost, variable cost, total cost, revenue, and eventually break even. So just keep following what I'm doing, and hopefully you will get an understanding of how this works. Now, I want you to think back to the fixed cost slide that you saw in the previous video. And you will remember that regardless of your level of output, whether you're making 10, 20, 30, 40,000, your fixed cost does not change. It remains a constant and it's a flat line perpendicular to the output line. So if I make 10, 20, 30, whatever, my fixed cost should not change, and that should be indicated by a straight line. And I'm gonna make it, let's say, 200. Let's say even if you make 0 units, you make 70,000 units, your fixed cost will remain constant. So that's a straight line. The other part of your cost structure is your variable cost. And we will remember from our discussion of variable cost that as your output goes up from 10,000, 20,000, you'll need more equipment, you'll need more raw material, more labor. So when output goes up, the cost of producing that goes up in terms of the variable cost of it. And I'm going to use, let's say, the color blue to show how the variable cost curve works. So let's say it's something like this. This is what our variable cost will look like. So at 10,000, it cost us 40 million. When we're making 20,000, 80, so on and so forth, giving us a upward sloping variable cost curve. Now, you will remember that my total cost is a combination of my fixed cost and my variable cost. And if I want to add, I'm going to show this and add it on my graph here. If I add my straight line of the fixed cost and the upward sloping line of the variable cost, it will start from 200 and it will go perpendicular to the variable cost curve. Why? Because even if you're producing 0 units, it will still cost it 200 million, right? The factory, the rent and all that is costing us that much. And with every extra unit that you produce, the amount of variable cost that you incurred gets added to this graph. So the combination of variable and fixed gives us our total cost curve. Remember, it will always start from where the fixed cost is starting and it will be perpendicular to the variable cost curve. So this distance between the red and the blue line indicates the fixed cost of the business. So we looked at the cost side of it. And you'll remember that break even, we're looking for a particular condition. Break even will occur where my total revenue is equal to my total cost. So I've got my cost structure figured out here. Now I need to figure out my revenue side. And think about it a little bit. No matter what something costs you to make, if it costs you $10, $20, you'd always want to sell it for more than it costs you to make, right? That's the only way you make profit. And with that logic, your sales or your total revenue curve will always be a steeper curve as compared to your total cost curve, because whatever it costs you, you're selling it at a higher rate to make a profit, which will show my total revenue curve to be upward sloping and more steep in its gradient than my total cost curve. Remember, if you're not selling anything, you're not making anything. When you sell 10,000, you sold it for this much, and so on and so forth, helping us plot a total revenue curve. So we've got the equations in. Now we've got to figure out where is this occurring. Remember, two things about break even: total revenue should equal to total cost, and that's where you didn't make profit. Neither are you making a loss. And yes, no marks for guessing this one. We can clearly see that at this point here, right in the middle, is where the company is neither making a profit nor is it making a loss. That's our break-even point. Okay, so if I want to look at this, it tells me that the company will break even, excuse me, at just over 40,000 units. Let's say this is, let's go with 42,000, right? So if the company decides to make 42,000 units, they will break even at this point. So this tells us a little bit about this whole graph. Another thing that we can deduce from this is that any time before the break-even point. Look at it a little bit logically. Just before this point, my total cost is always higher than my total revenue curve. The green curve is higher than the yellow curve, which indicates that throughout this point, where the cost is higher than my revenue, this is where I'm making a loss. However, as soon as we cross this break-even point, things start to look a little rosy. And this is where my total revenue curve takes the lead over my total cost curve, indicating this is my profit region. So what this means is that as soon as you make your 42,001st unit, it will start yielding you a profit. That's just what the break-even point helps us to identify. Now, I know what you're thinking here. And then, okay, we've done all of this to identify the point where we break even. Is that all? Should we just stop producing there? And of course not. The businesses will continue to increase their output, because the more they increase the output, the larger their profit margin becomes. And that leads us to another concept within the break-even analysis called margin of safety. Let's say that the company figured out that we break even at 42,000, but they are currently producing 70,000. So 70,000 is my current output. Okay, let's say for this month, the company decided to produce 70,000 units of this product. We already broke even at 42,000 and we've reached 70,000. That gives us this little region here in purple. Right? This purple region is part of your profit, of course, and it's called something in particular. This region, once I'm done with my OCD and coloring it, will indicate a region that we know as margin of safety. Okay, margin of safety. It's the distance between the point at which you broke even and your current output. Margin of safety. This simply indicates that within this region you can operate safely with the knowledge that you'll make a profit as long as you're making more than 42,000 units since you broke even at that point.